Well, thank you, Marc, for sitting down with us and having a conversation on our research highlights with the Business Diversity Center. I'd like you to introduce yourself and just tell us a little bit about your background and where you came from.
Okay. Well, currently I'm a professor of entrepreneurship in the management department here at Virginia Tech, of course. And here at Virginia Tech, I've also been actively involved in the entrepreneurial efforts here, such as the Innovate Living Learning Community, which I helped launch a couple of years ago. So my areas of research are generally related to entrepreneurship. However, before going back to get my PhD, I was in finance. So out of college, I went into finance. I had a background in economics, started working in finance and got an interest in entrepreneurship and did some entrepreneurial activities before I went back to get my PhD in business economics. In my dissertation, I focused on sort of the economics of entrepreneurship and things in that area. So.
Okay. With this background in finance and economics and entrepreneurship, how did you get interested in research in Latin America particularly?
Well, it's an interesting story. I was doing some research in venture capital and initial public offerings, basically looking at the financing of entrepreneurial ventures, how entrepreneurs sort of bridge that gap between being in a startup mode and raising capital so that they can grow their ventures. In my earlier work, I looked only at companies in the United States. We looked at the role that venture capital plays in the IPO process, for example, and some other things like that. When I was doing research in venture capital in the United States, we came across some data that showed us how much venture capital was going on in Latin America. And we noticed that it was just such a stark piece of data that we got more curious about it, because there was very little venture capital going on in Latin America, although there were billions and billions of dollars being invested in the United States. And you would think that with the close proximity of the United States to countries like Mexico and Central America and South America, that some of those billions of dollars might flow down into similar companies in Latin America in the form of venture capital. But it really wasn't. I mean, it was starting to happen, and this was, I think, back in around 2005 when I first started getting interested in this. So there was some amount of venture capital activity going on in Latin America, but it was much smaller than what you'd see in developed economies. So that was the first interest. Like, why is this? Really, when you think about entrepreneurship, an important part of growing an economy, growing entrepreneurship, and really for companies to grow, they need capital. You really need growth capital, particularly for certain kinds of firms, high growth firms, capital intensive firms that do a lot of research and development, biotechnology, sciences, all of these really meaningful industries in this current economy in the world usually need a lot of capital. So we started to realize that, if Latin America is not drawing this kind of capital into these kinds of companies, how will they compete in the future world economy? How will they create jobs? How will they create wealth down there for people in this more impoverished world? So that was the first interest. And I had a colleague who was from Chile, so we had some specialization there also in understanding Latin America. So we thought it was a great sort of direction to go into with his background from Chile, my background in finance, and another colleague who had a real background in understanding institutions around the world and how those impact growth. So.
Okay. I would like to get into barriers of sharing the VC, but before we get there, maybe you can tell us a little bit more about what is venture capitalism in general and how that relates to financing of businesses and organizations.
It's important to really understand what is meant by the term venture capital. Venture capital is a very specialized type of capital, and you see a lot of it in Silicon Valley, for example. Venture capital is really professional money. So a venture capitalist would be in a venture capital firm, and that firm, a venture capitalist, would go out and raise a lot of money and put it into what you'd call a venture capital fund. So they might go out and raise $100 million or $200 million and manage that money for those investors. Those investors could be large institutions like pension funds, mutual funds, high net worth individuals, governments. So people or entities that have a lot of money to invest might invest some part of their portfolio into venture capital. The reason they would only put some money into venture capital is because it's very high risk capital. So venture capitalist role is to come in and invest money into very high risk, high growth ventures that otherwise can't really get capital. So when you're a young technology startup, for example, and you might be the next Amazon.com, or you might be the next Yahoo or eBay or Google or Twitter, you might be, or a biotech firm that needs to invent the next drug for curing cancer. These kinds of companies may need a lot of capital to grow. However, they might also appear very, very risky. So what venture capitalists do is they create a pool of money. That way they can invest in many different ventures like that. So if we have a venture capital fund of $200 million, we might invest $10 million in 20 different companies over time. Now, of those 20 companies, maybe only 2 or 3 will really succeed, but because many of those companies might fail, the companies that do succeed have to succeed very big in order to make up for all the failures. So venture capitalists are typically investing into companies that can grow very large, very fast. So those are specific types of companies that end up, driving a lot of what goes on in the economy in terms of wealth creation, job creation. These are a lot of the name brand types of companies you hear about, the Apple computers of the world, and that. So venture capitalists are looking to invest in companies with large potential and fast growth potential, but at the time they invest, those companies are relatively small and risky. So it's a very specific type of investment. Now that's different from angel investors, for example, who are usually individuals, high net worth individuals that might invest in similar kinds of companies, but they do that investing individually as angel investors, whereas venture capital fund is an institution. It's professional, money managers who invest that money.
Right. So last semester we interviewed a gentleman doing research on microfinancing. What is the difference between venture capitalism and microfinancing?
Right. I would say, in an emerging market economy setting, which is where you find a lot of microfinancing would be the very first type of capital. Microfinancing goes in very small amounts of money. As you know, it could be even $50, even $100 of microfinancing can help an individual entrepreneur who's maybe in an underdeveloped country and they're trying to start their own business. They're really just starting out. So microfinance would be probably the very, very first amount of capital that would come in. Venture capitalists would be for those entrepreneurs that are a little bit later in the stage. They've already probably got their company together. They've got maybe some substantial intellectual property, maybe an invention, a new product, a new service, a new business model, something, and they're poised to start to grow rapidly. So because the venture capitalists need to invest a lot of money and they need to have a return on their investment for their investors, they're looking for companies that are a little bit further along. They're still very risky and still early in their stage, but you can tell that these are companies that could grow very big, and in order to do so, they need a lot of capital, and they really can't get their capital elsewhere. So you can think of financing ventures, and particularly in emerging market economies or underdeveloped countries, as a whole sort of spectrum or value chain of investing. And that would start with, the entrepreneur's own capital, maybe microfinancing type of capital, could go into maybe some crowdfunding type of capital. Certainly friends and family money plays a big role in those smaller, early formed companies. Then you might be getting into seeing angel investment and perhaps venture capital for the right kinds of companies. And then later those companies can begin to borrow money from banks and eventually maybe attract money from public markets like through an IPO. So there is this whole spectrum and sort of value chain of financing for entrepreneurial ventures, and anywhere along the line for a company that could break down. That could, if that money does not become available and the company hasn't started to turn a profit yet, then the company could just run out of cash and die. Even if it's a great company, a lot of times you just run out of money before you get to the stage where you can be self-financing. So it's a reason why entrepreneurial finance is very important, because there are a lot of really high potential companies that just aren't able to secure the financing, and then those individuals may have to close that company down, disband and do something else. So this is why it's very interesting to kind of look at why some companies and why in some countries it's easier to get capital and other times it's not so easy to raise capital, to try to understand those influences on entrepreneurial growth and economic development, so forth.